Dollar cost averaging. What is it and should I use it? Dollar cost averaging is when you invest a fixed amount of money on a consistent basis in the same investment. So let's imagine that you are saving for retirement and you're going to invest $1,000 every month in the ABC fund. Currently, ABC is trading at $50 per share. Since you're investing $1,000 this month, you're going to buy 20 shares, which is $1,000 divided by $50 per share. For now, we are ignoring any commissions, which we will come back to in a minute. Right now, your cost per share is $50. Simple enough. Well, next month, ABC falls to $40 per share. You invest the same $1,000 this month that you did last month, but this time you get 25 shares because the price is lower. $1,000 divided by 40. At this point, you own 45 shares, and you have invested a total amount of $2,000, making your cost per share $44.44, which you get by dividing $2,000, the total amount invested, by the 45 shares you own. The following month, ABC goes back to $50 per share, so you get another 20 shares for the new $1,000. Now you have invested $3,000 and you own 65 shares. Your cost per share averages out to be $46.15. So the theory with dollar cost averaging is that the higher the price of the fund goes, the less shares you buy. The lower it goes, the more shares you buy. Assuming that you have an investment that you have done a good amount of research on, and you are confident that over time it will rise in value, dollar cost averaging gives you the advantage of making the volatility of the fund work in your favor. This brings us to the potential downside. In our scenario, you invest $1,000 every month. But what if you wanted, instead, to invest $250 every week? Same amount as before, but you're going to do it more often. This is where the commissions I mentioned before can hurt you. So every time you place a trade, you generally have to pay commissions. If that commission is $10 per trade, if you only traded once a month, it will cost you $10. But if you did it weekly, it will cost you $40. Depending on the amount investing, that $40 may or may not change your mind as to the frequency that you invest. If you're investing just $50 per week, which is $200 a month, well, that $40 cost is going to hurt a lot since it's a large percentage of the amount invested. But if you're investing $1,000 per week, that $40 doesn't hurt as much on a $4,000 monthly investment. So in summary, to make dollar cost averaging work for you, have investments that you're confident in, choose a consistent amount and a consistent time interval. Keep an eye on your commission costs and make sure that they don't get out of control relative to the amount you invested. Then, stick with the program for the long run and you should do well. If you have any questions about the world of investing, any suggestions on videos, please post in the comments below and please subscribe as we continue to update with new videos every week. Thank you.